Hello and welcome to this chapter overview video where we will be looking at chapter 12, which is all about long-term liabilities. So we're going to look at journalizing transactions for long-term notes payable and mortgages payable, describe bonds payable. We're going to journalize transactions for bonds payable and interest expense, record liabilities on the balance sheet, and then take a quick look at the debt to equity ratio. So before we get into this, let's look at what the difference is between long-term liabilities and equity and how they fit together. So remember that when a business starts and when it wants to obtain funding, there are two choices, either by increasing its equity by issuing stock or by increasing its liabilities by borrowing money. So borrowing money, of course, involves interest. So anytime you borrow money, there's interest involved. Interest is required to be paid. It's not optional, and it's tax deductible. So interest is an expense that is deductible on the company's corporate tax return. Also, liabilities have to be paid when they mature. Stockholders' equity, on the other hand, involves getting money from investors. Now, one thing that might be involved here is that the company is issuing more shares of stock. So that means that the people that already hold shares of stock might have their ownership diluted. So they might own a smaller amount of the company. So that has to be considered. Also, stock may involve paying dividends. Now, dividends are not required like interest, but keep in mind that there are many companies that do pay dividends very regularly. And so for them, it is likely that they will pay dividends. And remember that common stock or issuing stock, the stock doesn't have to be paid back, right? All right, so remember that notes and bonds involve interest. So anytime money is borrowed, there is interest involved. And let's remember the two times that a company needs to record interest. The first is if the debt or the interest is being paid. So it's being paid to the lender. And then the second time is if it's at the end of the period, the accounting period, and the company's preparing financial statements, the company has to accrue interest for the period of time that it has incurred interest expense but not yet recorded it. Because of course, companies incur interest every single day, right? But they're not making journal entries every single day to record their interest. So this is an adjusting entry at the end of the period. So let's take a look at an example. On January 1st, $10,000 is borrowed on a 3-month 6% note. The note will be repaid on April 1st. So let's take a look at their journal entries. Now, you have some experience with this already, so my recommendation is stop the video for a minute and try to make these journal entries before you look at them. What is going to be the journal entry on January 1st, and what will it be on April 1st? All right, so hopefully you paused the video and you tried that out, because remember, anytime you try to recall something or you try to do something, even if it's completely wrong, you are learning because you're creating little connections in your brain. All right, so on January 1st, the company's recording a debit to cash and a credit to notes payable. Both of those items are going up. Cash is, of course, an asset. It has a debit balance, so we're increasing our cash. Notes payable is a liability with a credit balance, and we're increasing that. Then on April 1st, we're repaying the note along with the interest expense. So we're going to debit the note because it's going down. We're decreasing our liability. We're going to credit cash. Now, the amount of cash the company's going to pay will be the original note plus the interest it had to pay. And remember that interest is principal times rate times time in terms of a year. So the principal was $10,000, the interest rate was 6%, and the time is 3 months out of 12 months. All right, let's change up the facts a little bit. Let's say that instead the money is borrowed on November 1st on the 3-month note, and the note will be repaid on February 1st of the following year. All right, so hopefully you know that the borrowing entry will be exactly the same, right? So on November 1st, this is the same entry we made before, but it's on a different date. On November 1st, debit cash, credit notes payable. Now, we get to December 31st, which is the company's year end. And remember, I mentioned that we have to accrue interest because between November and December, 2 months of interest have been incurred. So the company owes 2 months of interest and it hasn't been recorded yet. So we're going to make an adjusting entry at the end of the year for accrued interest. And what that looks like is this. So we're going to debit interest expense. And again, principal times rate times time. This is only 2 months now because it's November and December. And then credit interest payable. When is this going to be repaid? This will be paid in February when we pay back the loan. All right, so let's look now and see what happens next year. All right, so this is just reproduced. That's the entry we just did. Now on February 1st, we're going to record the repayment of the loan. Now, we're still repaying the $10,150, right? It's the same amount as before. It's still a $10,000, 6% 3-month note. But our entry is going to be a little more complicated because we have the interest expense and the interest payable to debit. So first of all, we're going to debit the note payable. We're paying it off. We're going to debit interest expense, which is the interest for January, 1 month, because we haven't recorded January's interest yet. So $50 for January. And then $100, which is the payable that we recorded from last year. So the 50 is this year's interest, the 100 is last year's interest, and we repay the whole $10,150. All right, so let's talk about bonds payable now. A bond is a formal debt instrument, and it requires repayment at a maturity date, just like notes do. The difference with bonds is that it requires periodic interest payments. So interest payments have to be made every 6 months or every year throughout the life of the bond, which is generally a long period of time. Bonds are not a short period of time. They're a long-term liability. And the other difference is that bonds are issued in smaller increments. So rather than borrowing, say, $100,000 from one bank, the company could issue $100,000 bonds. So 100 different people or organizations could buy the bonds as opposed to one. So they're borrowing from a lot of different people or organizations. There are a bunch of different terms that discuss bonds, so let's take a look at these. A secured bond is backed by collateral. So you're probably familiar with collateral. If you took out a car loan, you are offering the company that loaned you the money your car as collateral. So that means that if you don't pay your car loan, they're going to come get your car, right? So that's what collateral is. So bonds can be backed by collateral. Most often bonds are unsecured and they're not backed by collateral. They're just backed by the finances of the company that is issuing the bonds. Then there are two kinds of bonds in terms of when they mature. A term bond matures on a single date, so it might be 10 years from now. A serial bond matures on a series of dates, so you might have 100,000 maturing this year, 100,000 next year, 100,000 the year after that, right? So they mature on 3 different or however many different dates. Now, a callable bond tells you that the company can call the bond back, meaning repay it early, under specific circumstances and for specific prices. They can't just call it any time and say, hey, I'm going to repay you now. So there are specific terms under which that can happen. And then a convertible bond, also under specific terms, that means that the bondholder can convert the bond to common stock. All right, so let's take a look at how we issue bonds. Now, bonds are a little bit complicated. We're going to look at them in a very simple way. We're just going to look at the issuance of the bonds and then the payment of interest and retirement. But there's a lot of other transactions that go on with bonds. We're not going to look at amortization in this video, but at a higher level, bonds are much more complicated than what we're looking at now, but we're going to look at the basics, okay? So, two important things when it comes to bonds: stated rate and market rate. The stated rate is the rate that you're familiar with, say on a note. Like the note that we looked at before had a 6% rate on it, right? That's its stated rate. So the stated rate for a bond is the same thing. This bond pays X percent, whatever it is. And that stated rate tells you how much interest the company is going to pay in cash to the bondholders. So the stated rate tells you the cash. The market rate is the rate out on the market at any given time that is being offered or being charged to companies that are loaning money, that are borrowing money and loaning money, right? That are similar to the company that you're looking at. So you're probably familiar with the fact that interest rates change all the time, right? So interest rates go up, interest rates go down. You might have heard discussions about, mortgage rates and how much money it costs to borrow money. That fluctuates over time. So that's the market rate of interest. What are currently what are similar companies offering in terms of debt that's similar to yours? Now let's see why those two rates are important. The relationship between the two rates is what determines the issuance price of bonds, because the stated rate stays the same, but the market rate changes. And so that's where it gets a little tricky. So let's look at the simplest case. The simplest case is that the stated rate is equal to the market rate. So if both rates are the same, the bonds sell at face value. Let's look at this example. On January 1st, a company issues $100,000 of bonds maturing in 10 years, paying 7% when the market rate is 7%. The bonds pay interest on June 30th and December 31st, and the issuance price is $100,000. Let's take a look at the journal entry to record this issuance. So basically, what you have to remember when you're recording a bond issuance is this: the issuance price is $100,000. This other information is going to be important later when we're recording the payment of interest. So basically what's happening here is the company is borrowing $100,000 by issuing bonds payable. Take a minute, pause the video, or just think to yourself, what does this journal entry look like? And I bet many of you can just get it, right? We're borrowing $100,000 on bonds. So hopefully what you said was, we're going to debit cash because the company is borrowing $100,000, right? We're getting $100,000 in cash, and we're crediting bonds payable. Cash is going up, liabilities going up. All right, so that is the simplest case where the stated rate and the market rate are the same. Now, remember, let's go back here 1 minute. Remember that we said they are issuing the bonds on January 1st and they pay interest on June 30th and December 31st. So twice a year, the company pays interest. So say it's January 1st, year one. Then when we get to June 30th, year one, it's time to make the first interest payment. So let's see what that looks like. So we're going to make our first interest payment. Remember, interest is principal times rate times time. The principal is the amount of the bond issue, the face value, $100,000. The interest rate is 7%. This is the stated rate. And 6 over 12 because it's 6 months have passed. Multiply those through and you get $3,500. This entry, this is really important. This entry and this amount is the same no matter how much the bonds were issued for. It doesn't matter. The issuance price does not matter. The thing that matters for interest payments is simply the face value of the bonds, the $100,000, and the interest rate. And the time, of course. So none of the others, the market rate doesn't matter, the issuance price doesn't matter. All right, so they are paying interest. Again, pause the video for a minute. Think about it. What entry are we going to make? The company is paying interest. hopefully you said, debit interest expense and credit cash. Okay? And so every 6 months for the entire 10 years, so 20 times, the company is going to make this journal entry. They're going to pay interest of $3,500. So the next time they'll do that is December 31st. So our balance sheet now looks like this. Bonds payable, $100,000. It's going to look the same for the next 10 years as far as this is concerned. Now, let's look and see what happens when bonds are issued for something other than face value. Remember that the issuance price of the bonds depends on the relationship between the stated rate and the market rate. So let's say the stated rate is less than the market rate. Now let's think about this for a minute. I'm telling you here that bond sells at a discount or less than the face value, but let's think about why. Let's say a company says to you, if you give us, say, $1,000, we're going to pay you 7%. Okay. But then, what if other companies are saying, if you give us $1,000, we're going to pay 8%? Are you going to give the money to the company that's paying 7%? No. Or if you are, you're going to give them less money. All right? So what happens is the company is going to get, in this case, $93,205. But in the end, they're going to pay back the $100,000 still. So the bondholders, in effect, earn the 8% over the life of the bonds. That's what's built into this. Okay? If you go on, you'll learn the way to account for the issuance of bonds and how to do all the calculations. But for now, what you need to know is that the bondholders are going to earn 8% because they're only having to pay $93,205 and they're getting back $100,000. Now, what happens to this discount on bonds payable? First of all, this is called a contra liability account. Remember, we had contra asset accounts, and they are like married to another account. So the allowance is married to accounts receivable. Accumulated depreciation is married to your equipment or your building, right? Discount on bonds payable, married to bonds payable. It can't live by itself, the discount on bonds payable, all right? So in time, over the course of the 10 years, this $67.95 is going to get smaller and smaller and smaller because it's going to be taken into interest expense. Because in effect, this is additional interest expense the company is incurring. Now let's see what this looks like on our balance sheet. So our balance sheet, this looks like every other contra account that you've seen. You have bonds payable of $100,000 minus your discount of $67.95 gives you $93,205. And then by the time this bond matures 10 years from now, this will be just the $100,000. So this gets smaller and smaller. As that one gets smaller, this gets larger. So the carrying value goes up, 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 up until it hits $100,000 at maturity. Sorry, that's carrying value of the bonds. Okay. So let's look at the third example now, and that's when the stated rate is greater than the market rate. In this case, imagine that the company says to you, I'm going to pay you 7% on your $1,000 investment. And you're like, okay. But then the market is only paying 6%. So basically, the company is going to get more money because remember, the bondholders are always going to earn the market rate. All right? They're always going to earn the market rate. The problem is this is fixed. So if the stated rate is greater than the market rate, the bonds are going to sell at a premium. So the company is going to get $107,439. That's the amount that the bondholders are going to pay to the company. And then we have this premium on bonds payable, and the bonds payable is still $100,000. This premium is called an adjunct account. It's not as common a word as a contra account, but basically it's added to the bonds payable on the balance sheet. Now remember, over the course of the 10 years, the bondholders are going to earn 6%, because that was the market rate. What's going to happen to this premium on bonds payable? It's going to be amortized, just like the discount. It's going to go away. It's going to get smaller and smaller and smaller. And the carrying value is going to go down, 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 till it hits 100,000. So let's look at what this looks like on the balance sheet. All right, so we have our carrying value on the date of issuance is 107,439. And remember that this is going to go away. It gets amortized. A premium amortization is a reduction of the company's interest expense, whereas a discount is an increase in the company's interest expense. All right, so now that we looked at all three issuance possibilities, face value, premium, discount, when the bonds are retired, so we assume now we get to the maturity date, nothing happened. Now it could be bonds are retired earlier, and that's a little bit more complicated. So we're just going to look at retirement at the maturity date, assuming there is no discount or premium left because it's already been all amortized. Basically, it's like paying off any other liability. You're going to debit bonds payable and credit cash. That's it. Okay? Just like paying an account payable, a note payable, anything else. So, if you were interested in buying a bond, you might go online and look, how much is this bond selling for? And the price that you're going to see is quoted as a percentage of the face value of the bond. So, as two examples here, a $100,000 bond issued for $98.75 means the bond will be issued for 98.75% of $100,000, or $98,750. Notice that if it's under 100, the bond is sold at a discount. Under 100, the bond is sold at a discount because a discount is less than face value. Then, if you had a $200,000 bond issued for $102.35, this is of course going to be issued at a premium because it's greater than the face value. And it's going to be issued at 102.35% of 200,000, or 204,700. So remember that bond prices are quoted as a percentage of the face value. Now, to report liabilities on the balance sheet, basically what you need to understand is which liabilities are current and which ones are long-term. So here there are many, many liabilities, some of which we've looked at, some of which we have not. Accounts payable, for example, hopefully everyone is familiar with that. That is a current liability. Remember, current liabilities are going to be paid within a year. So all of these liabilities will be paid within a year, including accounts payable, including all of the taxes payable, right? It doesn't matter, income tax, sales tax, payroll tax. All of those taxes are not going to be able to be paid more than a year, of course, right? Taxes have to be paid right away. Notes payable, notice, are in two different places. So a short-term note would be in current liabilities. So like the three-month note that we looked at before, that would be included in current liabilities. These two things, current maturity, this is called a current maturity of long-term debt. So if you had a note that is payable in installments, like a mortgage, the next 12 months of payments would be considered current. It's actually the principal of the next 12 months that would be considered current. The other thing that would be here that I don't see is unearned revenue. Remember, unearned revenue, notice that all these have the magic word that tells you that it's a liability, payable. So unearned revenue is a little tricky because it does not have that payable word to tell you, hey, I'm a liability, right? So don't forget unearned revenue. That would be generally a current liability. Then let's look at our long-term liabilities. Again, we have notes payable, so this notes payable must be payable after a year from now. We have mortgages. Then we have a bond with a discount. So here's the face value of the bond. Here is the remaining discount. Subtract it, and then you add, this is the carrying value. Remember, this is the carrying value of the bond, and we add that to our other long-term liabilities. Then we add up our current liabilities and our long-term liabilities to get our total liabilities. And of course, under this on the balance sheet, you would see your stockholders' equity, right? Finally, let's take a look at the debt to equity ratio. So the debt to equity ratio is fairly simple. You would go to the balance sheet and you're going to look for your total liabilities, like the number we just saw, and you're going to divide that by total stockholders' equity. This is a measure of financial leverage, and the higher the ratio, the more leverage. The more leverage means you have more liabilities. Let's take a quick look at what leverage is. So here's an example. Let's say you're buying a $500,000 building that you're going to use to rent, and it generates $120,000 in a year. So there's two possibilities here. Say you put a $100,000 down payment and you take out a $400,000 loan. Well, the return, we're simplifying this a lot, keep in mind, the return on the $100,000 investment is $120,000 divided by 100,000, or 120,000. I'm sorry, 120%, right? However, because why? We only invested 100,000 and the rest is borrowed. If no money had been borrowed and we paid the whole 500,000 down right away, then the return is on that investment is 120,000 divided by 500,000, or only 24%. Now, of course, there's interest involved here, so this is vastly simplified just to give you the idea of this, but there's interest involved here, and of course there's more risk because you do have to pay that interest and you're going to have to pay that loan back, right? So, there's risk and reward. But that just gives you an idea of the difference between borrowing money and not borrowing money. And of course, if the interest rate of this loan is less than the amount that you're earning, that's good, right? So if you're borrowing money at 5% and you're earning 10%, that's a good thing, right? Okay, so that's all I have for you for today. I hope this helps you with your studies, and I will see you at the next video.